Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Berkshire Hathaway's new chief executive follow-up. Insurance remains core to the business and the conglomerate structure is secure. That statement from Berkshire Hathaway's new chief executive in the Wall Street Journal is not just reassurance. It's a restatement of the entire Berkshire thesis in a single sentence. If you believe that line, you can stay in your seat. If you doubt it, you should probably sell. We are reading the Wall Street Journal today as investors, not as tourists, and this issue gives us a rare second look at Greg Abel in his new role. In the previous day's coverage, he acknowledged that Warren Buffett is a hard act to follow. In this follow-up, he doubles down on the two pillars that make Berkshire different: the insurance engine and the conglomerate model. On screen, you'd be seeing the Journal's business and finance lead. A brief summary that Abel confirmed insurance is still central, and that the conglomerate structure is not up for dismantling. The text notes that he intends to keep Berkshire's decentralized model, where operating company CEOs are left largely alone, and at the same time, he personally will oversee the stock portfolio, maintaining a concentrated approach with big holdings in companies like Apple, American Express, Coca-Cola, and Moody's. Let's take each part. First, insurance as the core. Berkshire's real superpower has always been disciplined underwriting plus intelligent investment of float. The Journal calls out Ajit Jain by name, quoting Abel praising him as peerless at pricing risk correctly and walking away when the price is wrong. That's not casual flattery. It's a signal. The heart of Berkshire's compounding machine is intact and being explicitly defended. On screen, you'd see a short visual mention of Berkshire's insurance subsidiaries and a line or two about their historical role, generating low-cost float that can be invested in equities and businesses. Think of that as the internal bond market that finances the rest of the empire. Second, the conglomerate structure. In a world where activists and consultants are forever pushing focus, spin-offs, and pure plays, the Journal notes that Abel reaffirmed the conglomerate setup. He is not breaking Berkshire into pieces. He is not turning it into a holding company that trades chunks like a private equity shop. Instead, he is keeping the ecosystem: railroads, utilities, manufacturing, retail, and specialty operations all under one umbrella, with capital flowing internally based on opportunity, not Wall Street fashion. That matters because the main knock on conglomerates is capital misallocation. They overinvest in fading units and starve the winners. Berkshire historically inverted that. The Journal describes how Abel plans to operate a decentralized model with autonomy grounded in deserved trust in the CEOs, while expecting accountability and integrity in return. That's classic Berkshire. Autonomy is earned, not gifted. The inflection point is subtle. Buffett is gone as CEO. Ajit still runs insurance. Abel is now the key allocator. The question is whether he can maintain ruthless discipline on when to underwrite risk, when to walk away, when to repurchase stock, and when to sit on cash. He signals seriousness by explicitly saying he will keep Berkshire's concentrated style in the equity portfolio. That's a choice. Fewer, bigger bets, not an index closet. For us, the capital allocation autopsy is ongoing, not finished. So far, every public move Abel has made, and the way he talks in this Journal piece, leans toward continuity. Keep the insurance engine. Maintain decentralized operations, centralized capital allocation at the top. Concentrate the equity portfolio in a handful of high ROE, durable franchises. If you own Berkshire, you are in effect betting that a culture can survive its founder. This article from the Wall Street Journal is early evidence that the new steward knows exactly what must not change. Next title: Pension Funds, AI, and Private Markets. Now shift from Berkshire's internal machine to the institutions that own pieces of businesses like Berkshire, pension funds. The Journal reports that pension funds are now explicitly trying to understand what artificial intelligence means for their private market investments, especially in software-heavy portfolios. For decades, the default assumption was that owning private equity and private credit, backed by software and mission-critical systems, was a smart way to juice returns with manageable risk. The environment has changed. AI introduces a new uncertainty: which software businesses will be disrupted, which moats will dissolve, and how much of private market NAV is built on business models that are quietly eroding. On screen, you'd see text summarizing how pension funds are combing through their exposure to software and AI themes in private funds. asking whether their diversification is actually just a concentrated bet dressed up as alternatives. This is a classic capital allocation reality check. For years, institutions piled into private markets under three beliefs: that private equity and private credit were less volatile than public markets, that they were uncorrelated diversifiers, that the value creation in software buyouts and software lending would be robust. But as the journal notes, much of that low volatility is an illusion created by infrequent marks, what some investors now call volatility laundering. You don't see the price move not because risk is low, but because no one marks it daily. AI is forcing these funds to reevaluate whether their private exposures are just illiquid versions of the same tech and software risk they already hold in public equities. For long-term owners like us, this is a warning. If your pension fund or endowment is heavily committed to private software strategies and now also owns the hyped AI hyperscalers in public markets, you might have doubled down on a theme without realizing it. The journal's coverage here is a gentle way of saying, do a correlation audit. Moving to next title, Fidelity's record profit. It's the plumbing of asset management. The Wall Street Journal explains that Fidelity's profit just hit a record, thanks to a long rally that pulled billions of dollars of new customer money into its accounts and funds. This is a business that benefits when markets go up, but more importantly, when participation rises. They make money on assets, not just performance. On screen, you'd see a note that profit rose to an all-time high, linked to inflows and strong markets. Imagine a simple bar chart: rising assets, rising profit. The capital allocation here is industrial. Fidelity has to decide how much to invest in platforms, technology, advice, and marketing to win more assets. It's the opposite of a stock picker. It's a scale machine. When markets are healthy and households feel flush, flows surge. The revenue model, fees on assets under management and other services, compounds on top of those flows. But the inflection point is always the same. What happens when markets correct, or when fees compress? Fidelity's record profit in this environment is a reminder that asset gatherers are leveraged to both prices and investor psychology. If you own or underwrite businesses like this, you have to think in terms of cycles. The journal is showing you the top of a wave, not the long-term mean. Page B3 to Norwegian Cruise Line and the Activist. Moving to next title, Norwegian Cruise Line and the Activist. The journal then moves us to a very different kind of operator, Norwegian Cruise Line. The CEO tells the journal he is focused on cutting bureaucracy to turn around the cruise operator, which is under pressure from an activist investor. That sentence contains the whole story. Bloated overhead, activist scrutiny, and a management team that has to prove it can improve returns without destroying the product. On screen, we'd see text describing the CEO's emphasis on removing layers, speeding decisions, and responding to an activist that wants better performance. You might also see mention of cost initiatives and strategic shifts. For years, cruise operators were scale and marketing stories. More ships, more routes, more cabins filled. Then the pandemic and its aftermath exposed how fragile the model is when ships can't sail, when debt piles up, and when customer preferences shift. Now, with activists circling, the core question is, can Norwegian improve its unit economics, revenue per passenger, and cost per passenger without cutting into the experience so much that demand suffers? This is a pure capital allocation and incentives problem. The activist wants higher returns, sooner. Management wants breathing room to invest in service and upgrades. The balance sheet, still carrying scars, limits how much they can spend. The inflection point is whether this management team uses activist pressure to rationalize a bloated corporate structure and redeploy savings into the fleet and customer experience, or whether it simply strips costs in a way that slowly commoditizes the business. The journal is telling you that the CEO at least knows what he has to say. Kill bureaucracy. The harder question is what he actually cuts. Moving to next title, Elliott's sweetened bid for Toyota Industries. Then you have Elliott the activist on the other side of the table in another story. The Wall Street Journal reports that Elliott agreed to a sweetened bid for Toyota Industries that values the company at almost $40 billion, clearing the way for the Japanese forklift maker to be taken private. Forklifts are not glamorous, but they are capital-intensive, durable assets at the heart of logistics, warehousing, and manufacturing. On screen, you'd see a short text block summarizing that Elliott's higher offer persuaded stakeholders and that Toyota Industries, a major forklift producer, is now set to leave the public markets. The capital allocation angle is straightforward. Elliott saw a business with steady, somewhat boring cash flows, and probably a valuation that didn't reflect its asset base and long-term demand. Public markets often undervalue these kinds of companies, especially in an era obsessed with software and AI. By taking it private at a richer price, Elliott is doing three things: giving current shareholders an exit at a premium, gaining control over capital allocation without quarterly scrutiny, betting that, under private ownership, the combination of operational improvements and better use of cash can generate a return above that buyout price. This is exactly the sort of situation we should study. These deals tell you what sophisticated capital thinks is mispriced. If Elliott is willing to commit billions to a forklift maker at a near $40 billion valuation, that says more about the world of real assets and logistics than any conference presentation. Moving to next title, AR Labs, NVIDIA, AMD. Now to the headline-grabbing part of the issue. IR Labs. The Wall Street Journal describes IR Labs as a decade-old chip startup backed by NVIDIA and AMD that just raised $500 million from investors, valuing it at $3.8 billion. It's a silicon photonics company, essentially working on using light instead of electricity to move data on and off chips. On screen, you'd see text noting the size of the raise, the valuation, and the involvement of NVIDIA and AMD as backers. There might also be a description of IR's technology focus, chip-to-chip optical interconnects, and why it matters for AI workloads, which are increasingly bottlenecked not by raw compute, but by how fast data can move. This is classic picks and shovels investing. Instead of trying to guess which AI model wins, you back the infrastructure needed by all of them. NVIDIA and AMD putting money into IR Labs is a signal. These are not naive investors. They understand where their own platforms bottleneck. From a capital allocation perspective, IR's story is about optionality. At $3.8 billion, it's not cheap. But if its technology becomes integral to the next generation of data center chips, that valuation could be a rounding error. If it fails to reach scale, it could go to zero. NVIDIA and AMD, however, are not just chasing financial return. They're securing a strategic supplier and influencing a technology path that could protect their own franchises. For us, the question is whether we want to own picks and shovels like this directly, or whether we prefer to own the larger platforms that can place many such small bets. The journal is showing you one specific case of strategic venture capital by incumbents. Moving to next title, IAC and Care.com. The journal then covers Barry Diller's IAC agreeing to sell Care.com, an online marketplace for caregivers, to private equity firm Pacific Avenue for $320 million. On screen, you'd see the headline and a short summary. IAC is pruning its portfolio, selling this unit to a financial buyer. IAC is a serial conglomerate builder in digital businesses. Its playbook has been to incubate, acquire, and then eventually spin or sell assets once they reach a certain stage. The sale of Care.com at this price tells you a few things. IAC believes it has better uses for capital than continuing to own and operate this marketplace. Private equity believes there is still enough juice in Care.com at this valuation to improve margins, grow, or package it for a later exit. The market for online service marketplaces is mature enough that these assets are now portfolio pieces, not the future of the internet. This is capital recycling. Diller and his team are doing what Abel is doing, but in a very different context, trimming lower return branches and reallocating to higher opportunity areas. For investors, the discipline to sell a business that no longer fits your highest return vision, even if it's a known brand, is critical. The journal's note is a simple reminder. Not every asset is sacred. Moving to next title, Destination Charges and Car Economics. One of the most interesting microstories is about cars, specifically destination charges. The Wall Street Journal highlights that consumers are running into a new kind of sticker shock. Destination charges that now average around $1,600 per vehicle. The fee is supposed to cover shipping the car from the factory to the dealer, and it has climbed as fuel and other costs have risen. On screen, you'd see a chart showing average destination fees over time, rising from a few $100s toward the mid-four figures. You'd also see text explaining that this fee is often non-negotiable and tacked on after the base price is advertised. Here's the capital allocation reality. Automakers have invested heavily in new platforms, electrification, and technology. They have seen costs rise in logistics, fuel, labor, transport. Instead of absorbing all those costs, they have pushed them onto the buyer in a line item that feels like a footnote but is real cash. Destination charges are an example of how pricing power shows up in small print. From the investor's side, this is margin defense in a world of tighter competition. If customers keep paying these fees, it suggests that brand strength and product desirability are still high enough that an extra $1,000+ doesn't kill demand. But there's a limit. When fees like this grow faster than the headline price, trust erodes. The journal is capturing that liminal moment when customers are starting to notice. For the long-term owner, the company that manages to keep transparency and still earn fair returns will be the one that survives the next credibility cycle. Moving to next title, Zombie Tower in Miami. Then there's the Zombie Tower. The journal describes a zombie high-rise on Miami's waterfront that sits in legal and financial purgatory. Residents sold out of a condo building to developers who plan to redevelop it into a new luxury edition branded tower. Most owners agreed. A handful did not. Lawsuits followed. The old structure was vacated. The new one is delayed. Capital is stuck. On screen, you'd be seeing the journal's photo of the empty tower on the bay. Windows dark. Project stalled, along with text explaining that some former unit owners turned down offers that were several times their original purchase prices because they want to move back into a rebuilt tower, not take the cash and walk. One owner, a retired SEC lawyer, bought his unit for a bit over $250,000 in the early 2010s, spent a similar amount renovating it, and says developers offered him more than $1 million. He refused. Now he is suing, alleging fraud and wrongful eviction, and seeking tens of millions in damages along with other holdouts. For investors, this is a case study in how real estate capital can get trapped when legal, human, and financial incentives collide. Developers see a site, a brand, and upside. Lenders see collateral value and a plan. Most owners see a windfall and say yes. A small group sees a home, not an asset, and says no even at high multiples of cost. The result is a stranded asset. Land that cannot be monetized, capital that cannot be recycled, and a ghost tower on prime land. The journal's coverage makes one thing clear. In development, the last few percent of holdouts can destroy the entire IRR. For us, the lesson is that capital-intensive, highly regulated, highly human projects have a different risk profile than spreadsheets imply. Legal friction, local politics, and individual preferences can invalidate the pro forma. Now towards last article, alternative investments the pros like now. Finally, the journal's Guide to Wealth section dives into what professionals are actually doing with alternative investments right now. This is where you see how allocators are trying to defend and grow capital in a world of high equity valuations and tight credit spreads. On screen, the reader is shown a set of interviews and commentary. Wealth managers and CIOs talking about hedge funds, global macro, private credit, secondaries, AI vehicles, and hard assets like railcar leasing and grid conversion businesses. Several points stand out. First, long, short, and market-neutral strategies are back in favor. Managers emphasize that, with equities near highs and spreads tight, traditional 60/40 portfolios look vulnerable. Long-short hedge funds that can play both sides, buying quality, shorting weak names, are seen as tools to navigate volatility. Global macro strategies, which trade across currencies, rates, and commodities, are highlighted as especially interesting in a deglobalizing world, where different regions are moving at different speeds on inflation and interest rates. Second, interval funds and evergreen structures are getting real traction. The journal notes there are nearly 200 interval funds now, including a massive private credit vehicle with tens of billions in assets and a strong multi-year return record. These funds give individuals quasi-institutional exposure to private credit and other illiquid assets in exchange for limited liquidity. Typically, only a small percentage of capital can be redeemed quarterly. But the article also warns about volatility laundering. The co-founders of a major quant shop joke that the smooth return lines in private funds are a function of stale marks, not magically low risk. Beneath the surface, the business risk is very real. Third, the pros worry about secondaries. For the last couple of years, private equity secondaries, buying existing interests in funds at a discount, were the darling of allocators. Now, some CIOs tell the journal they're cautious, especially when there's poor transparency. The fear is that what's being sold into secondaries might be zombie exposure, assets that tie up capital without realistic upside, even if they're nominally marked at decent valuations. Fourth, they're leaning into specific hard assets and infrastructure themes. One CIO highlights railroad leasing. Railcars are essential for moving bulk goods. Most shippers don't want to own them, so they lease. A good leasing platform can generate steady cash flow that is largely neutral to traditional equity and bond market moves. Another theme is grid conversion. One allocator describes backing a specialist team that helps electrical contractors expand across state lines to handle the surge in demand from electric vehicles and AI data center buildouts. The insight is that the real money may be in the midstream wiring, contracting, and the local regulatory know-how to connect electrons to infrastructure. Fifth, niche private credit remains attractive. Investors are wary of big generic private credit funds, where underwriting standards may have weakened. Instead, they are targeting smaller managers doing bespoke middle-market deals that larger lenders don't understand or can't efficiently underwrite. One example cited yields in the mid-teens, with diversification across industries. Lastly, there's targeted enthusiasm for AI exposure beyond the hyperscalers. One wealth platform worked with a Silicon Valley team to build a hybrid vehicle, part private, part public, that gives investors exposure to AI growth beyond the giant mega-cap names, with monthly liquidity after an initial lockup. This is an attempt to balance access to the theme with some liquidity and risk control. The common thread in all these alt choices is a search for two things: real diversification, not just new wrappers for the same equity risk, cash flows that are less tied to public market cycles, leases, hard assets, niche lending, and infrastructure services. Lessons and ending. When you pull back from all of this, Berkshire's steady hand, pension funds worrying about AI in private markets, Fidelity's record profit, Norwegian's activist pressure, Elliott's forklift bet, IR Labs' photonics raise, IAC's portfolio pruning, rising destination fees, Miami's zombie tower, and the alternatives menu, you see the same questions repeating. Who is actually allocating the capital? What are their incentives? And how are they adapting as the environment shifts under them? Berkshire's new CEO is deliberately choosing continuity, anchoring the conglomerate on insurance and concentrated equity bets while preserving decentralization. Pension funds are discovering that alternatives can be more correlated to their existing risks than they thought. Fidelity is surfing flows in a bull market, but those flows can reverse. Norwegian has to decide whether to use activism as a discipline or as an excuse for short-termism. Elliott is quietly paying up for a boring but essential industrial. IR Labs is a leveraged bet on the plumbing of AI, backed by the very incumbents it could help. IAC is selling mature assets to fund the next generation. Automakers are pushing costs into fees until customers push back. Developers in Miami are learning that a few holdouts can freeze hundreds of millions in value, and the pros, in their alternatives picks, are trying to find streams of return that will keep working when the obvious trades stop. The core question this issue of the Wall Street Journal asks us, even if it never states it directly, is this: can you find leaders and structures that will keep making intelligent capital allocation decisions as the world changes, or are you just buying beautifully packaged exposure to yesterday's conditions? The one sentence I want you to carry with you is this: the only true edge in long-term investing is aligning yourself with people and systems that can change their behavior before the world forces them to, and then giving them the time for that discipline to compound. This is Avi. Like and subscribe. On to the next.